What if the biggest roll-up bet in building products distribution is also one of the riskiest balance sheet stories in the market right now? That tension is exactly what we're unpacking today. QXO Inc. is now the largest publicly traded distributor of roofing, waterproofing, and complementary building products in North America. Roughly 600 branches across the US and Canada, about $5.5 billion in revenue after closing the massive Beacon acquisition in April 2025, and a stated goal of reaching $50 billion in revenue through serial acquisitions. The architect behind this strategy is Brad Jacobs. He's done this before: United Waste, United Rentals, XPO Logistics. He builds platforms by consolidating fragmented industries and extracting operational efficiency at scale. The track record is real, but past success does not automatically protect common shareholders in the next chapter. So let's look at what the 10K actually tells us. The underlying business is strong. Roughly 80% of revenue comes from repair and replacement demand. Roofs leak, roofs age, structures need waterproofing regardless of the economic cycle. About 94% of that repair and replacement revenue is classified as non-discretionary. This is not a luxury category. It's necessity spending wearing industrial clothing. The company serves more than 110,000 customers. No single account represents more than 1% of sales. That's meaningful diversification for a company of this scale. Its private label brand, TriBuilt, carries higher margins and exclusivity. And the industry remains highly fragmented. More than 500 independent local dealers still operate across the market. Consolidation is in the early innings. The moat exists, but it isn't yet a fortress. Regional competitors can replicate parts of the model locally. Scale improves with each acquisition. For now, the moat is more about trajectory than depth. Now we get to the complicated part. QXO paid roughly $11 billion for Beacon. The deal was funded with $4.5 billion of new debt. In May 2025, management prepaid $1.4 billion of that term loan. In November, they repriced the remainder and cut the margin. Those are disciplined moves, but here's the number that demands attention. Total funded debt sits around $3.1 billion. Add lease obligations, and total obligations exceed $4 billion. At acquisition close, leverage was roughly 5 to 6 times EBITDA. That's elevated. That's not a balance sheet with room for error. Fiscal 2025 produced a net loss of approximately $279 million. Yes, that includes debt extinguishment costs, large amortization of acquired intangibles, and transaction expenses. But in a serial acquisition model, those one-time costs repeat. Every deal brings transaction fees and restructuring charges. There's also an $848 million deferred tax liability tied to intangible assets, non-cash today, but economically embedded. And then there's a disclosure that serious investors should not ignore. Beacon, which represents 99% of revenue, was excluded from the internal controls assessment. The auditors did not independently evaluate controls over the business generating nearly all reported revenue. This is permitted under SEC rules for newly acquired businesses. But think about that. The engine room of the company has not yet been fully assessed for control weaknesses. Unknown risks are never comfortable. Now layer in capital structure complexity. Multiple series of preferred stock, Series A, B, and C. A $3 billion Apollo commitment for Series C preferred to fund the next acquisition. 3 tranches of warrants outstanding. Preferred dividends get paid first. Dilution risk is real and ongoing. And in February 2026, QXO announced the $2.25 billion Kodiak acquisition, funded with cash and stock. Beacon is not yet fully integrated, and the company is already layering on another multi-billion-dollar transaction. There's one more risk. Brad Jacobs is explicitly identified as a key man dependency. The entire strategy hinges on his judgment. No formal succession plan is disclosed. If Jacobs steps back, the thesis changes. So what does this mean for a serious investor? The demand profile is durable. The US housing shortage is real. The aging housing stock is real. Weather-driven roof replacement is accelerating. But the financial wrapper introduces real fragility. Leverage near 6 times EBITDA. Persistent dilution. This is a good business wrapped in an aggressive financial structure. If execution is flawless, upside is meaningful. That's the honest read on QXO. Hit like and subscribe for weekly 10K analysis and tell me, are you betting on Jacobs or does the leverage keep you cautious?